Hello everyone, welcome to the Chartered Accountants Academy video lectures. My name is Davidzo Paradzai, and in this video lecture we are going to cover other engagements. As an introduction, a professional accountant may be required to perform other engagements other than an audit of financial statements. This can be a special purpose audit engagement, agreed upon procedures, compilation engagements, review engagements, or maybe a due diligence. So we are saying a professional accountant, an auditor, may be asked to come and perform an audit of financial statements as per ISAs, or they can be engaged to come and perform other types of engagements as listed. I will further explain those types of engagements as we move on with the lecture. So, what are our learning outcomes? At the end of this video lecture, you should be able to identify and understand different levels of assurance that can be expressed by an auditor, the reports for other engagements. You should be able to design procedures to be performed for the following engagements. That is a due diligence exercise or a review engagement. You will remember from your undergrad studies that there are two broad types of engagements that can be performed by a professional accountant. That is an assurance engagement or a non-assurance engagement. We will further define, we'll further explain these types of engagements. For an assurance engagement, the professional accountant will express an opinion to enhance the degree of confidence of users about the subject matter. What are the types, the examples of assurance engagement? A non-statutory audit of financial statements for a buyer or a seller, the review of interim results or annual financial statements, internal control review. You will remember that the professional accountant is coming to enhance public confidence with regards to financial statements. So they will express their opinion under an assurance engagement. So there are only two types of assurance engagements permitted. That is reasonable assurance and limited assurance. For reasonable assurance, we are saying the professional accountant is providing high but not absolute assurance that financial statements are not misstated and are expressed positively. Limited assurance is moderate assurance that financial statements are not misstated. It is expressed negatively. So, for assurance engagements, there are three parties that you will need to consider. The practitioner, who is the preparer, who is the professional accountant, right? The responsible party, the owner of the engagement, the owner of the task of the financial statements to which the professional accountant is coming to express an opinion on. And also the users, the audience, the ultimate audience of the financial statements that the professional accountant will express an opinion on. So, in carrying out these non-assurance engagements, our code of ethics still applies. ISQC 1 still applies, as we have learned at the beginning of the year. Now, for non-assurance engagements, we are saying the professional accountant will not express an opinion, but will, however, report on factual findings, and users will draw own conclusions from those findings. Different from an assurance engagement where they expressed an opinion. A non-assurance engagement, they will report only on factual findings, and users will draw on conclusions from those findings. What are the examples of these types of engagements? a reconciliation, a due diligence exercise, a compilation of financial statements, the preparation of tax returns, consultations, or maybe advice with regards for management, tax issues, and all. We are saying the user of the information will draw their own conclusion, and the professional accountant will not have expressed any opinion. That's a non-assurance engagement. So now, what is a review engagement and how does it operate? As per ISRI 2400, the practitioner's objectives is to obtain limited assurance primarily by performing inquiry and analytical procedures about whether the financial statements as a whole are free from material misstatements. That's under a review engagement. The engagement does not require a positive opinion, but rather requires some credibility as given to the financial information which is reported on limited assurance. The professional accountant is coming to give credibility to the information, right, through the use of what? Limited assurance, which enables the practitioner to express a conclusion on whether anything has come to the practitioner's attention that causes the practitioner to believe the financial statements are not prepared in material respect in accordance with any applicable financial reporting framework. It is just a conclusion, not an opinion, that nothing came to our attention that we can say the financials or the information has not been prepared in accordance with applicable financial reporting framework. So how is positive and limited assurance expressed? For positive assurance, as per ISA 700, we are saying the auditor will express a reasonable level of assurance to say, in our opinion, right? Thereafter, they will explain the scope of the work, the description of the scope of the engagement to convey to the user that comprehensive procedures were performed. However, for a review whereby limited assurance is provided as per ISRI 2400, we are saying a moderate level of assurance is conveyed by not using the phrase "in our opinion," but rather stating that nothing came to our attention that causes us to believe that the financial statements are not fairly presented. Limited assurance. This is supported by the scope paragraph, which conveys that limited procedures were carried out, that an audit was not conducted, and that no opinion is expressed. So that will be the difference. For an audit, an opinion is expressed. For a review, no opinion is expressed. However, just stating that nothing came to our attention that causes us to believe that the financial statements are not fairly presented. So, what type of procedures are performed under a review? You make use of inquire, analytical reviews. Procedures not used in a review will be inspect, reperform, recalculate, agree to. Those detailed procedures, those detailed substantive procedures that we use in an audit will not be used in a review. In a review, you make use of procedures such as inquire and perform analytical procedures, to compare current year and prior year, right? Then the professional accountant may be engaged to perform agreed upon procedures, whereby the professional accountant is called in by an organization to say, this is what we want you to do for us. For this set of financials, we want you to come and perform a reconciliation. We want you to come and perform an impairment calculation. We want you to, they are agreed upon procedures, right? So the professional accountant will come and do exactly what there has been agreed upon with the person who will have engaged them. So what are the key characteristics? In an agreed upon procedure engagement, the auditor is engaged to carry out procedures, usually of an audit nature, which have been agreed upon by the parties involved. For example, the auditor, the client, and the interested third party, they agree upon the scope of the work to be done. The auditor reports only on the facts found. No opinion or assurance is given. The users of the report are required to draw their own conclusion from the facts presented. The report is restricted to those parties that have agreed to the procedures to be performed, since others, unaware of the reasons for the procedures, may misinterpret the results. Work that was done was based on agreed procedures. Let the report only go to the party that engaged the professional accountant, because others may not know the agreed upon procedures, and if they receive the work, they may have incorrect conclusions. So let the report only be given to the party that engaged the professional accountant. So refer to ISRIS 4400 Appendix 2 for an example of an agreed upon procedure report. Then also, very common in the market are due diligence exercises. What is it? Due diligence reviews normally involve the investigation of a business or a person prior to signing a contract or an act with a certain standard of care. The professional accountant is asked to say, before we perform this measure, we want you to go and understand the other party that we are engaging. Before we go and perform, we carry out this acquisition. Go and understand the acquiree, right? So it's an investigation of a business or person prior to signing a contract or an act with a certain standard of care. A common example of due diligence in various industries is the process through which a potential acquirer evaluates a target company or its assets for an acquisition, like I mentioned earlier on. The theory behind due diligence holds that performing this type of investigation contributes significantly to informed decision making. Why would you want to perform a due diligence? It's because you want to have informed decision making before an acquisition, before a merger, right? This enhances the amount and quality of information available to decision makers, and by ensuring that this information is systematically used to deliberate in a reflexive manner on the decision on hand and all its costs, benefits, and risks. This entails that when a professional accountant performs a due diligence review, they will report on their factual findings, which are then used by management on their decision-making process to make their own conclusion. Are they going to go ahead with the merger given the information? Are they going to go ahead with the acquisition given the risks associated? So, how does the practitioner gather information? Normally, when a professional accountant performs a due diligence review, they will perform procedures similar to the ones performed for an ISA audit. That is, for example, inspection for employment contracts for key staff, inspection and physical verification of assets. This you will remember from audit evidence, right? Inspection of communication with an entity's legal counsel. So this is how the practitioner gathers information. Then also, the professional accountant may be engaged to perform a compilation engagement, whereby they are coming to compile financial statements, to compile information that can be analyzed, that can be used by management, by the users of financial statements, right? In a compilation engagement, the accountant is engaged to use accounting expertise as opposed to auditing expertise to collect, classify, and summarize financial information. No testing is conducted and no assurance is given in the report which accompanies the compiled information. It's just a compilation of information using accounting expertise. It would ordinarily include the preparation of financial statements, which can be a complete set of financial statements or a part of the financial statements, but may also include the collection, classification, and summarization of other financial information. So you can refer to ISRIS 4410 Appendix 2 for examples of a compilation report. So this brings us to the end of the video lecture. I hope you will find this useful. Make sure you also go and further understand in your module, go to your standards, flag, have an appreciation of the kind of reports that are expressed for other engagements, right? Best wishes. Thank you.